Good afternoon, members. Welcome back. This is a post-lunch session. Hope so. The next speaker will not tax you. He'll give you some tax reliefs. So I welcome the speaker. May I request the chairman to escort the speaker, Deepak Chopra, and present him a floral bouquet. Members, I have been given the task of introducing the speaker. It's a pleasure. I would like to introduce the speaker. CA Deepak Chopra is a fellow member of the Institute of Chartered Accountants of India and a commerce graduate from Bangalore University. He is qualified as a chartered accountant in 2011 and has since built his professional practice with a deep and enduring passion for direct taxes. For over a decade, Deepak was actively engaged in teaching, sharing, sharing his knowledge with students of chartered accountancy and company secretary courses. He was a regular faculty member at the Bangalore branch, handling direct tax classes for CA final students. He has served as a resource person for direct taxes matters on numerous professional forums across the country. He has also delivered sessions hosted by the Committee for Members in Practice of ICAI. His expertise has been recognized by the Income Tax Department, where he has been a faculty member for the officers at the National Direct Tax Academy and the Direct Tax Regional Training Institute, Bangalore. He has also had the honor of deposing before the Select Parliamentary Committee constituted for the review of the new Income Tax Bill 2025, providing insights drawn from his professional experience and legal understanding. Deepak currently serves as the chairman of the Direct Tax Committee of the Karnataka State Chartered Accountants Association, contributing to policy decisions, knowledge sharing, and professional development activities for the members. As the founding partner of Deepak Neeraj and Associates, he heads the Direct Tax Division, guiding clients with practical, insightful, and solution-oriented advice. Let's welcome the speaker. Yeah? Deepak, sir, the stage is all yours.
Yeah, working now. Namaskar and a very good afternoon to one and all present here. At the outset, I would like to thank Bangalore branch, Chairman sir, the entire staff, office bearers for having invited me here to present my thoughts on legal issues and tax audit. Post-lunch sessions are generally difficult sessions. Now, in the course of my introduction, sir read out my professional career post 2011. Pre 2011, that is before I got into this commerce course, I was a student of science. Newton was my favorite. His laws of motion are applicable and relevant everywhere till date and even here. First law of motion, bodies in rest will continue to remain in rest until an external force is applied. I promise not to be that external force. As long as you promise not to snore loudly. Law of motion number 2, the energies needed to stay awake in a post-lunch session is directly proportional to the mass of the lunch, which I am told is going to be heavy because the lunch was really nice. And the third law of motion, every action has an equal and opposite reaction. So for all the attempts that I'm trying to make it humorous and more lively, it's perfectly okay for you to yawn back. It's science, right? Okay. Coming to the topic, tax audit. Tax audit has been there in the statute books for more than 4 decades now. It's not new to us, right? We've been practicing it since the day one we stepped into this profession. In fact, even before we stepped into the profession as an article assistant. Of course, over the years, it's undergone some tweakings, changes here and there. But then, since 2018, there hasn't been a major overhaul to the tax audit report as well. 2018 is when we saw a major revamp, a new set of clauses and reporting requirements were inserted by the amendment carried on in 2018. But since then, it's been largely stable. We all know how to fill a tax audit report, sir. Right? Ratri 100 gante idru, we'll do it, sir. It's there in our blood. In fact, I can say probably it is there in our DNA. Our kids will not have to attend tax audit sessions. They'll do a tax audit without having attending a session. But then, it's a ritual, it's a convention to have a tax audit session, to prepare ourselves for the tax audit season. Now, having said all this, given all this background, the point that I'm trying to make is, we will not now, in this post-lunch session at least, get into a clause-by-clause analysis, because that's something which is very well known to us. We very well understand. Right? Now, how many of us here now want a clause-by-clause analysis? Or rather, how many of us don't want a clause-by-clause analysis over here? The rest of us want to sleep. Huh? Now, that's also an option available to you. It's your choice, free world. So with this thought process, with this background in mind, we thought we'll do some legal issues, some practical aspects, practical issues, which may be of help in our daily practice. It may help us in discharging our tax audit functions in this current tax audit season. So the way it is structured is, there are a bunch of issues that have been collated, which we'll try to answer in a question and answer session, right? Question and answer session, right? We'll pick up issues collectively, we'll try to resolve them. And my only humble request is to make it as interactive as possible for the benefit of all. Okay? And if there is some duplication, in the sense that there is something that I propose to deal with now, but has already been dealt with in the morning session, please let me know then and there. We'll quickly move on to the next slide. Right? To those at the back, is this visible? Yes. Chairman sir is saying those who can move front will have their tax audits completed faster within due date. There are screens over there. Okay. Perfect. Okay. We'll start with, before getting into specific issues pertaining to various clauses of Form 3CD, we'll do some basics of the tax audit and the presumptive tax provisions per se. So the first query, the first issue on hand is, whether can a partner offer his salary and interest that he derives from a partnership firm carrying on business activity, can he offer this remuneration and interest to tax under presumptive provisions of 44AD? I'll give you an example. Let's say I'm a partner in a business entity carrying on some trading activity, and I receive partner's remuneration of 10 lakh rupees. This is taxable under the head income from business and profession, right? And against this, am I not eligible to claim expenses that I have incurred to earn that income? I may have hired a driver, I'll have a car on which I seek to claim depreciation, I have petrol, conveyance, telephone expenses, etc. Now, to cut short all of this expense maintenance requirement, can I offer this to tax under 44AD? 10 lakh is what I have received, 8% of 10 lakh, 80,000, I'll offer it to tax, chapter closed. Is that an option available to me? No? Why so, sir? Not a business. As perfectly pointed out by sir, 44AD is applicable to an eligible SEC carrying on eligible business. And what Madras High Court tells us in Anand Kumar's case is, in a partnership setup, who carries on the business? It is the partnership firm, right? To call remuneration received in the hands of the partner a turnover or gross receipt, is incorrect. For 4480 to work, you need turnover and gross receipt. It is 8% or 6% of the turnover. To say that the remuneration that you're deriving from the partnership firm is your turnover is inappropriate. Indeed, it is taxable under the head PGBP by virtue of a specific charging section under section 28, but then it is not turnover and the partner is not carrying on any business activity. Therefore, 4480 provisions are inapplicable in this case. Partner has received 11 crores in remuneration from partnership firm. Is the partner required to get the books of accounts audited under 44AB clause A? I'm a partner in a business entity, a business firm, and I've received 11 crores in remuneration. Do I have to get my books of accounts audited? Continuing with the previous slide's analogy, ratio, I am not carrying on business. 44AB is applicable to an SSE carrying on business and with certain turnover thresholds. I am not carrying on any business activity as is told to me by Madras High Court and reaffirmed by Bombay High Court in the case of Perizad Zorabai Nirani, wife of famous actor Boman Irani. She was a partner in a marketing firm and she received remuneration in excess of 1 crore. Those days the turnover limit for audit to be applicable was 1 crore. Department insisted that she ought to have got her books of accounts audited, and for the failure of getting her books of accounts audited, levied a penalty of 1,50,000 under 271B. Bombay High Court, following Madras High Court, says, see, it is a partnership firm which is carrying on the business activity and not the partner himself, and therefore there is no audit requirement. There's no business, there's no turnover, and there's no audit requirement in the hands of the partner with regards to the remuneration that he receives from the partnership firm. A continuation of this may sound a little repetitive, but is relevant. A CA receives interest and salary of rupees 150 lakhs as a partner from his partnership firm. He has no other income. Should the CA be subject to tax audit? So much of repetition, no. Same logic. Assessee, the partner is not carrying on business. It is the partnership firm which is carrying on business. 44AB clause B is applicable only to an assessee who is carrying on profession and his gross receipts exceed a certain threshold. Rightly or wrongly, fortunately, unfortunately, that is not the conclusion that is to be drawn here. Courts have viewed business and profession distinctively. With regards to, when it comes to profession, the courts are of the view that profession requires intellectual skill. It's something very personal, which a partnership firm, a non-individual entity, does not possess. So in a CA firm, it is a bunch of chartered accountants holding COP who together carry on the practice of chartered accountancy. Therefore, whatever they receive through the partnership firm are professional receipts and they ought to get their books of accounts audited. Right? That's been held in a new number of cases. The most cited and the most popular one being the Sagar Datta's case in Kolkata Tribunal. Now, these are all partners of Big Fours who failed to get their books of accounts audited, having received remunerations in excess of the thresholds of 44AB clause B, and ended up paying penalties under 271B. Right? Can he get 50% exemption is something that I will not answer now. But then can he offer it to tax under 44 ADA? The answer would be yes. Is 44 ADA eligible to remuneration received from a professional firm? I would say the answer is yes, following the logic and reasoning given by the tribunals that we saw in the previous scheme, that it is the partners carrying on profession collectively and whatever is received by them through the partnership firms are professional receipts. So 44 ADA is applicable. Yeah. Now that's another controversy. We can take it up now. I had a separate slide on that. So the query is, the presumptive rates of 8%, 6% or 50%, whatever, can I get away by declaring income at those presumptive rates, although my actual income is much higher than those presumptive rates? Is that the right thing to do? As a professional, 50% example, okay. Is that the right thing to do? Now, if you read the provision carefully, it would say 6% or 8% or 50% or such higher sum as may be claimed by the assessee. As may be claimed by the assessee. To me, to my mind, it is in the interest of the assessee to claim that higher sum if indeed he's earned that higher income. To make things simple, I'll take an extreme example, right? Let's take an example of a doctor who in his first year of practice gets 50 lakhs in professional receipts, right? Doctor has absolutely no expenditure. He has no staff. He operates out of his house, pays no rentals. Probably the only expenditure he incurs is probably on some telephone and electricity. All put together, not more than 5 lakh incurred in expenditure. So his actual income is, let's say, 45 lakh. Now, would it be wise on his part to offer only 25 lakhs to tax and file his return of income? The answer would be no. The reason being, the differential 20 lakhs would end up in some sort of an asset. It could be a fixed deposit, it could be a mutual fund, or it could be a simple savings bank deposit. Now, that excess stands the risk of being taxed as unexplained investment, which suffers a much higher rate of 60%. 115 BB surcharge is included, it goes up to 79-80%. So it is in the interest of the assessee himself to offer the higher sum to tax in order to be able to justify his investments and assets. Right? Now, this was an extreme example. You may argue that what if the difference is 1 lakh, 2 lakh, or 3 lakh, 5 lakh? If the difference is small, probably you should be in a position to get away. So the practical way out, practical approach to this problem should, in my mind, be that even in presumptive cases, at least draw a statement of affairs. I'm not saying maintain detailed books of accounts. Draw a statement of assets and liabilities. Look at the incremental net asset. Net asset is assets minus liability. Assets minus liability opening, assets minus liability closing. Look at the increment that you have made during the year and see if it is matching to the income that you have offered to tax. If no, that incremental asset is subject to be tested under 68, 69 and the other deeming provisions, attracting a much higher tax rate of 115 BBE. You spent it for personal use without leaving a trace, then that's fine. But then let's say you've spent that 20 lakh in our example, you've not invested in an FD, but you've spent that 20 lakh on a foreign trip for which data is available on the AIS portal. Then that's not unexplained investment, but unexplained expenditure. The same consequences would follow. So we'll have to be a little smart and a little thoughtful in how we deal with these cases. Agreed that maintenance of books of accounts is not warranted, but then some basic computation has to be carried on. Some basic books, if required, should be maintained to be at least be in a position to arrive at a statement of assets and liabilities. That much basic effort is taken care of, and I think we are good to file our returns. As tax auditor, does the scope of audit extend to personal books of the SEC as well? The answer is clearly no. From years of practice, we know it, that the scope of our audit is subject and restricted to only the business activities of the SEC. What the SEC does beyond his business books is none of my concern, none of my business. Right? Now, this has got some judicial backing also. In the case of Ghai Constructions, a beautiful Bombay High Court judgment wherein the Bombay High Court examines this matter pretty exhaustively. The Bombay High Court in this judgment goes into the report of the expert committee which was constituted and upon the advice of which the tax audit provisions came into the into the law books. It goes into 44AB provisions, it goes into 3CD, it goes into Rule 6G, and after examining all of these, concludes that tax auditor is not required to certify or look into the personal books of the SSC. The facts of the case are pretty interesting here. So, Ghai Construction is a proprietary concern who had applied for a tender of Government of Maharashtra. Now, the tender had some net worth requirements. Now, the business books of Ghai Constructions did not meet the net worth requirement, but the business books coupled with the personal books, he met the net worth criteria and he applied for the tender. But his tender application was rejected on the grounds that the tax auditor had signed only the business books and not the personal books. which is where High Court came to the rescue to say tax auditor is never required to certify the personal books. Now, why so much of discussion and so much of time being spent here is because in practice, we a lot of times are pressurized by our clients and more so from their bankers to also sign and certify their personal books. So there is where you can take shelter of this judgment, throw it on them to say, no, this is beyond the scope of my tax audit. As a separate audit assignment, I can audit the personal books and certify that as well, but certainly not part of the tax audit assignment. Now, in fact, the general advice given is that when we fill in clause 1 of Form 3CD, which requires us to fill in the name of the SSE, the normal normal practice is to fill in the name as per the PAN records. So if it's Mr. A, you would write Mr. A with the exact spelling matching with the PAN database. But then a good practice would be to go on to add and say Mr. A, proprietor of X and company, to make the reader of the tax audit report very clear that the scope of my audit is only business books and not anything beyond the business books. This is something that I've discussed earlier as well. I'll fast track this. Do disallowances like 43B attract in the case of SSE whose income is computed under 44AD? I'll give you a small example. Let's say my turnover is 1 crore. Everything is come in cash for simplicity. 8% of 1 crore comes up to 8 lakh rupees. That's the presumed rate of income under 44AD provisions, right? Now, one additional information that I'll supply to you now is, I have an unpaid GST liability standing 31st March 2025 of rupees 10 lakh, which I have not paid even till date. Now, what should be my taxable income? Is it 8 or 18? 44AD provisions, presumptive tax provisions, we are all well aware, are inclusive of all allowances and deductions. So the question here is it also inclusive of all disallowances? So is my taxable income to be reported in the ITR 8 or 18? 8. Unfortunately, that's not what was concluded by Panji Tribunal in Good Luck Kinetic. Now, what Panji Tribunal did here is, it went into the text of 44AD and also read the text of 43B. Interestingly, both are non-obtained provisions. The 44AD starts with the clause, notwithstanding anything contrary contained in section 28 to 43C of the Income Tax Act. 43B also starts with a non-obtained clause, notwithstanding anything contrary contained in any other provisions of the Act. Right? So we have two non-obtained clauses fighting against each other. Now the court had to decide which would prevail over the other. Rightly or wrongly, court went on to conclude 43B would prevail over 44AD, and the reasoning given was, now look at 44AD. 44AD is overriding a small set of provisions, which is section 28 to 43C, whereas 43B is overriding the entire Act. So the overriding powers of 43B are of far wider amplitude than that of 44AD, and therefore 43B would have to prevail over 44AD. To sum it up, in the light of Panji Tribunal's this judgment, the taxable income in the example that we just took up has to be 18 and not 8. But this could have possibly been argued in some other fashion also, no? There could have been other arguments to counter this. When you say 44AD overrides 28 to 43C and 43B overrides the entire Act, one more possible argument that could have been made is to say that this is specific in its override, whereas this is general in its override. Specific provisions always prevail over general provisions. That could have been argument number one. Second technical argument that could have possibly been made over here is, when 44AD overrides 28 to 43C, it overrides a very important and powerful section called 29. Now, if you look at the scheme of taxability under the head PGBP, PGBP chapter starts with section 28, the charging provision. It is followed by 29. 29 is the beginning of the machinery provisions. It is section 29 which tells you that income chargeable to tax under the head 28 shall be computed in accordance with the provisions of 30 to 43D. And 29 does not have any non-obstain clause. It does not have any notwithstanding provision. So 44 AD very clearly and smoothly and without any hindrance overrides 29. When 29 is overridden, there is no question of making an application of 43B. So on those grounds as well, in my humble view, Panji Tribunal should have concluded 8 lakh as taxable income and not 18 lakh as the taxable income. And there's a third way of arguing this, which was what was taken up before Raipur Tribunal in the case of Krishna Kumar Agrawal. Another interesting case wherein, again, there was a fight between 44 AD and 43B. Now, in this case, the assessee had unpaid interest. Interest dues to bank is also one of the items which falls under 43B, right? And department sought to add it to the income declared under 44 AD. Tribunal said, no, that's not possible. Look at that computation. Look at his ITR. What has he done? He said 8% of 1 crore, right? In this entire computation, do you see any claim for allowance of interest expenditure? Has he anywhere in this computation made a claim for interest deduction? And the golden rule of disallowances is always disallowance has to be preceded by a claim for allowance. When there is no claim for allowance, there is no question of making any disallowance. The expenditure is sitting as my liability, and 43B would want to disallow it and allow it on cash system. Yes. No, the tribunal said, I will not even get into that. It is presumptive taxation wherein no expenditure has been claimed in an item-wise format. When there is no item-wise claim for expenditure, there is no question of item-wise disallowances. As you rightly said, when I say 8%, in this 8%, implicitly I am making a claim for 92%. But does that 92% specifically include interest expenditure? Answer is no. It's an all-inclusive. It's an all-inclusive presumed rate of taxation wherein we don't do item-wise accounting or item-wise claim for allowances, and there cannot be item-wise disallowances as well. Is GST collected part of turnover? I have raised an invoice of 1 crore during the year. That's the only invoice I have raised in the year. I have charged 18% GST. My invoice value reached 1 crore 18 lakh. My sales account is credited with 1 crore. Now the 6%, 8% presumptive rate to be applied on this 1 crore, would it be 6%, 8% rate to be applied under 44 AD, would it be on 1 crore or 1 crore 18 lakh? 1 crore 18 lakhs? 1 crore? Anybody supporting 1 crore 18 lakh? I as a department official put it to you, it should be 1 crore 18 lakh. Please defend. I know I'm not a nice guy. I'll give you some elaboration to my argument. Now please read 145A and ICDS 2. A combined reading of both would tell you that I am mandated to follow inclusive system of accounting. In fact, 145A is very categoric and very explicit in its reading. It says the value of purchases, sales and inventory shall be adjusted to include, that's the word used, shall be adjusted to include tax, duty, cess, fee, etc. So now please tell me how it is 1 crore and why not 1 crore 18 lakhs? No, technically if you have to ask me, legally speaking, 1 crore 18 lakh is the right number because of the mandate given to us under 145A. But then very recently we had a very convenient and a beneficial judgment which we should cling on to. Oceaneering International, it's a German company, and the case was before Mumbai Tribunal. The case involved the provisions of 44BB, but then I believe the ratio should equally apply to 44AD as well, and 44ADA also for that matter. Now what Mumbai Tribunal held here is, tax is not an income. Tax is a liability which I collect on behalf of the government and I discharge it to the government. To say that tax would form part of turnover would result in tax on tax. Now if I have to compute 8% on that 18 lakh also, then it is tax on tax, which is not right under law, and therefore, tribunal concluded 1 crore is the correct number and not 1 crore 18 lakh. Rightly, wrongly, fortunately, unfortunately, this 145A wala galata did not come up there. That matter was not raked up over there. जब आएगा तब देख लेंगे. So clause 13A requires us to report on the method of accounting. As we all know, we have two methods of accounting given to us under 145, and the option is given to the SSC to choose between the two. Mercantile system of accounting, which is nothing but the accrual system of accounting, and the cash system of accounting. Now the question here is, can I follow different systems of accounting for different heads of income? Yes. My professional income, I will offer it to tax under cash system of accounting. My income from other sources, I will offer it to tax under accrual system of accounting. Very well valid. There's a lot of judicial backing to it as well. The logic being, the ratio being that the choice of method of accounting is source specific and not SSC specific. It is not that if as an SSC I have chosen accrual system, it applies to all my items of income. No. I have the option to choose between accrual and cash for every source of income. In fact, within each head of income also have an option to choose between accrual and cash system. So let's say I have within PGBP, I have professional receipts. I also have a business activity. Let's say I'm also into jewelry business. Now the jewelry business, I can continue to offer to tax under accrual system. My professional receipts can be offered to tax under cash system of accounting. Perfectly valid, upheld by courts. So when it comes to the question of accrual versus cash system of accounting, can a conclusion be made that for companies, cash system of accounting is never an option? They always mandatorily have to follow accrual system of accounting. Or can companies also choose cash system of accounting? If you read section 128 of the Companies Act, section 128 of the Companies Act would mandate every company to follow accrual system of accounting. But then if you come down to 145 of the Income Tax Act, the Income Tax Act gives an unconditional option to every SSC to choose between accrual system of accounting and cash system of accounting. There's no restriction or condition under 145 to say, hey, companies will only follow accrual system and the option of cash system is not available to companies. So how do you reconcile these two? Now, one possible way of reconciling these two is to say I will maintain two separate parallel set of books of accounts, two separate parallel set of financial statements. One under accrual system for compliance under company law. The financials that I prepare and present in the AGM before my shareholders, I will follow accrual system of accounting. But the financials that I will adopt and use as base for my income computation and for my ITR filing, I will follow cash system of accounting. Possible? Possible. 3CB. 3CB, because the stat audit report, which we normally use for our base as 3CA, is not what I am adopting for my tax returns, is not what I am auditing in my 44AB provisions, and therefore it has to be 3CB, 3CD, and not 3CA, 3CD. And this arrangement of maintaining two parallel set of books, accrual for company law and cash system for income tax law, is being upheld and being given blessings by Calcutta High Court, Mumbai Tribunal, as well as Hyderabad Tribunal. Subject to the risk of you being able to satisfy the assessing officer as to what is the reason for the variance between your company books and IT books. Here, turnover or income is higher by 10 lakhs. Subject to you be able to produce a reconciliation statement, this is perfectly valid, perfectly, very much possible. Clause 18 requires us to report on depreciation. Now, what is the depreciation rate we adopt for printers, scanners? Under computers, 40%. Anybody 15%? 15%? It has to be between 15 and 40. No, it is either plant and machinery 15% category or computer. Computer is also plant and machinery, interestingly, under the Act, but that's under 40% category. If you read Rule 5 with that Appendix 1A, it will say computers and computer software, 40%. Computer is not defined in the Act. The general understanding and the common dictionary meaning of the term computer would be, it's an electronic device with input, process, output. right? Electronic device with an input, with a processing unit, and with a output unit. Now, taking this definition as base, we have a host of judicial pronouncements which go on to say printers, scanners, monitors, your displays are all computer peripherals. These are part of the computer system, right? A printer and a scanner is an input device. It has no independent existence. It comes into play, it functions only when it is connected to a computer system. So it's part and parcel of the computer system. Likewise, your monitor is a output device. Same logic would apply even to UPS. UPS, if it is used as a exclusive power backup for the computer system, then it's part of the computer system. It's a computer peripheral, depreciated at 40%. If you have a UPS for your general lighting, then that would have to be depreciated at 15%. Okay. Mobile phones? 15%? 15. Mobile smartphones, sir? So, sir is in agreement with Kerala High Court in Federal Bank's case, a 2011 judgment, wherein Kerala High Court also said mobile phones 15%. There's no real reasoning given over there as to why it is 15%, but then High Court has concluded over there to say it is 15%. Possibly 2011 smartphones were not that much in fashion there, and judge probably had a button phone, Nokia types, whatever. Now that held ground for a long period of time until 2015. We had a Mumbai tribunal judgment wherein Mumbai tribunal said, hey, mobile phones are handheld computers. It has input, process, output. You can touch. There is an audio input. There is a visual output. There is an audio output. These are computers with computing powers. These are devices with computing power. These are handheld computers. So 40%. But then the gem of a decision came from Chandigarh Tribunal in Kohinoor Private Limited, wherein Chandigarh Tribunal went into the depth of the issue to say, why do we buy a mobile phone? To make calls, WhatsApp, Facebook, Gmail, right? So Chandigarh Tribunal concluded that it is a communication device. The predominant purpose of a mobile phone today is, you may use it for Excel and PowerPoint and all other applications as well, no denying that. But the primary purpose of buying a mobile phone today is to use it as a communication device, and therefore it has to be depreciated at 15%. RCC pleaded, "Yo, printer gella 40% kottidira, that dumb printer which will only print a document. My mobile has got 32 GB, 16 GB RAM today. Like printer, I can connect mobile phone also to computer, no? No, but then court drew a distinction to say, no, see, printer has no independent existence. It functions only when it is connected to a computer system, whereas mobile has an independent application. In addition to its independent application, you can also connect it to a computer system. That's a different story. But then its primary purpose and its primary application is that of communication, and it's a communication device and not a computer system. So 15%. Today's modern day printer can also work Wi-Fi. It can connect to a mobile phone also. We'll have a separate case law on that in future, sir. Okay. Clause 19 gives us a long list of special provisions, no? Like 35D. Coming to 35D, without getting too much technical into clause 19, 35D provides for amortization of pre-incorporation expenses, preliminary expenses, right? So whatever is the expenditure you have incurred prior to incorporation, you amortize it over a period of 5 years at the rate of 1/5 every year, right? So the question here is whether premium on subscribed share capital is capital employed in the business of the company under section 35D to be eligible for deduction. Now, if you look at the 35D arithmetic, there is a qualifying expenditure, and the qualifying expenditure has a cap. The cap is put at 5% of capital employed, right? And capital employed has a definition. Capital employed means the sum amount of money raised by way of issue of share capital, debentures, or long-term borrowings. The question here is the share capital that is used in the word, in the definition of the term sum employed, capital employed, will it include share premium also or not? To give an example, let's say I had a public issue this year. I raised 100 crores by way of public issue, wherein 99 crores came in as security premium and 1 crore came in as share capital. Now the question here is, the 5% test, 5% cap that has to be applied, is it 5% of 100 crores or 5% of 1 crore? The Supreme Court concludes it is 5% of 1 crore, going by a very strict and literal reading of the term share capital. Share capital is share capital. Share premium is something that you put under reserves and surplus. It's not part of your capital. Therefore, you will not include security premium in your 35D computation. True, I cannot have share premium without share capital, but then 35D is interested only in share capital. I think I'll skip this part. This is interesting. Software development in progress, abandoned and written off in books of accounts. What is the nature of such expenditure? This is something I think we encounter quite often with the startups that we have today. Startup starts off with all fan and fair. There's a lot of R&D work. There's a lot of money which is put in terms of developing a product, developing a new software. Year 1, 10 crores intangible work in progress. Year 2, 25 crores intangible work in progress. Year 3, write off the entire thing. For whatsoever reason. I failed to secure a further round of funding. When technologies become obsolete, I failed to succeed in my project. My founders have quit and I don't have a technical team that can take forward the project. XYZ reason. Year 3, I debit 35 crores intangible work in progress, written off, impaired. Now the question is, can I claim deduction for this 35 crores? Courts have said yes, because it does not result, the 35 crores that you have spent has not resulted in creation of any asset of permanent nature. It has not resulted in creating a benefit of enduring nature. Includes our Karnataka High Court in the case of Adadin Technologies. Penalties. So clause 21 is also, I think, the biggest clause that we have in our Form 3 CD. A bunch of expenses and disallowances that we are required to report as part of our reporting in clause 21, which includes we reporting on penalties. Right? Penalties are covered under section 37(1) of the IT Act. 37 is our residuary tax provision, right? Any expenditure which does not fit into 32-36, if it is incurred wholly and exclusively for the purpose of business, you claim it under 37. But then 37 also has its exclusions. Personal expenses, capital expenses, expenses which are penal in nature don't fit in to 37(1). They have to be disallowed. With regards to penalty, the words used is any expenditure which is for the purpose of an offense or which is prohibited under law. Now, the question that is being put on the screen here is, are interest for delayed payment of taxes, interest for delayed payment of VAT, GST, PT, PF, ESI, all of these, are these penalties that I have to disallow under 37(1) and report it in my clause 21? No? Yes? So time and again, courts have consistently held that all these interest clauses are time compensation of money. These are not penal in nature. They are not punishing you for an offense. They are only charging a compensation for the time value of money. You had to pay to the government by 31st of March. You have paid it with a delay of 2 months. For the 2-month delay, the value of the time value of the money is what is you pay to the government in the form of interest, and it's not penal in nature. And because it is not penal in nature, it should not be disallowed. Right? The most cited and the most landmark in this series of judgment is Lakshman Das Mathur Das. So we have cases specifically in the context of sales tax, PF, gratuity, service tax. I'm sure the ratio of this judgment would equally apply to the interest that we pay under section 50 of GST law as well. Now speaking of interest on GST, the next thing that immediately comes to our mind is, what about late fee? Late fee paid for delayed filing of GST returns. Late fee paid for delayed filing of TDS returns, 234E, 200 rupees per day. Are those penal in nature? Should that be disallowed? Disallowed? 234E. ABC, I'll come to that, sir. I'll come to that in a while. I'm presently on late fee, 234E. To be disallowed, not to be disallowed? Not to be disallowed. Now, when 234E was introduced, I think it was in 2012, all across the country at high courts, writ petitions were filed by various associations and tax practitioners on the ground that it is violative of constitution and principles of natural justice. The argument made was 234E is penal in nature. You do 1 day delay, you're penalized by 200 rupees per day. And this penalty is being levied without an opportunity of being heard, because the law today provides for an automatic and a compulsory levy of 234E. Moment you file, intimation will come from CPC Ghaziabad, 234E is levied. So across high courts, the tax associations and tax assessees made a plea that this is violative of principles of natural justice and should be struck down. Should be struck down. Now, interestingly, the department made a plea there to say fees are very different and distinctive from penalty. Penalty is kind of a punishment for doing something wrong, whereas fee is for some service given. Fee is a quid pro quo arrangement. No, we charge professional fee for rendering professional services. What service do I get from department from filing TDS return? I am doing a service to them by filing TDS return. No. Their argument is the due date for filing TDS returns for Q2 of 24-25 is 31st of October. Now you miss the deadline, you file it on 1st of November. It's a privilege extended to you. So it's a privilege fee. It's a privilege extended to you, allowing you to file your return beyond the statutory due date. That was argument number one. Argument number two, and a more logical one, was to say, whenever a deductor makes a delay in filing the TDS return, the deductee suffers. On 26 days, he'll credit appear agalla, there'll be a demand, then he'll file a rectification. There's a whole lot of reconciliation. In fact, to tackle this reconciliation, we have a traces body sitting in Ghaziabad. So the fee charged is towards all these activities. And court said, yes, you're right. So we have that judgment which went against us then will have to be used in our favor to say courts have now drawn a thick line of distinction between a fee and a penalty. Fee is not penal in nature. Fee is not a penalty, and therefore it has to be allowed for deduction, should not be disallowed under 37(1), should not be reported under clause 21. We spoke of interest a short while ago. Continuing with that, what is the fate of interest for delayed remittance of TDS? Allowable, not allowable? Same reasoning, Lakshman Das, Mathur Das should apply. Interest is not penal in nature, it is compensatory in nature. In fact, in the context of 201(1)(a) penalty, there is a Karnataka High Court judgment in the case of Orient Insurance Company, wherein Karnataka High Court has categorically concluded that interest under 201(1)(a) is compensatory in nature and not penal in nature, and therefore it is mandatory in nature. But then this piece of law has had an interesting evolution, starting from Kolkata High Court and Madras High Court. Madras High Court Chennai Properties is the more cited one. It is the more popular one, which we will see other courts have followed subsequently. Now, Madras High Court and Chennai Properties had an interesting take to this to say, hey, look, we are not into compensatory or penal in nature. What is the true nature of this interest? Let's identify that first. True nature of any interest is the same as that of the principal. Interest always partakes the nature of the principal. It borrows colors and characteristics from the principal. When I speak of interest on TDS, what is the principal here? TDS. TDS is nothing but income tax. And income tax is a specific item of disallowance under 48(2), no? 40 clause A, subclause 2, it is a specific item of disallowance. Therefore, when principal itself is not allowed as allowance, how can interest be allowed as allowance? Disallowed. This stood for a long period of time until in 2005 we had another Kolkata judgment in the case of ABN AMRO Bank, 2005. Very peculiar judgment. There the High Court for some reason concluded, it did not even get into the controversy of 48(2) interest principal now. It said, see, remittance of TDS is whose responsibility? Principal officer. Now he delays, it's his personal responsibility and it is not the expenditure of the company. So in the hands of the company, it's a personal expenditure and therefore I'll disallow it under 37(1). Something hard to digest, a company having personal expenses. Nevertheless, Fortunately, it died its death. Nobody has cited this. Henceforth, probably I should be removing it from my slides also. Then came the third set of judgment, again from Calcutta Tribunal, a very good one. Narayani Ispat, a favorable judgment followed across the country by all tribunals, Bombay, Chennai, Delhi, everywhere they followed it. They dug deeper into the issue. Now, what did Madras High Court tell us? Interest on TDS is disallowable under 48.2. Kolkata Tribunal said, hey, read 48.2 properly. What does 48.2 say? 48.2 speaks of disallowance of tax on profits of the assessee. Tax on profits of the assessee. When it comes to interest on delayed remittance of TDS, whose tax is it? It is the deductee's tax. It is not tax of the assessee, and therefore it cannot be disallowed under 48.2. Sound reasoning, logical, should be followed, should be applied even here. Unfortunately, Bangalore Tribunal says no, disallow it. Bangalore Tribunal in Expact Engineering says, see, on this matter, I have two set of judgments. One favorable, another adverse. Applying the law of precedence, I will follow High Court judgment over tribunal judgment. Ironical, no? Calcutta Tribunal is not following Calcutta High Court. Bangalore Tribunal is following Kolkata High Court. But then I believe we have a strong case to make and argue and defend to say it should not be disallowed, and on a case-to-case basis, depending on the risk involved and the assessee's interest, you can take a call. Can depreciation be disallowed under 40A1A if tax is not deducted at source on the purchase of fixed asset? No. I bought a computer software for use in my office. 1 lakh rupees. I ought to have deducted tax at source under 194J. For some reason, I forgot. Now, on this 1 lakh, I have claimed 40,000 depreciation. Now, can this 40,000 be disallowed? No. That's what Karnataka High Court tells us in the case of Tally Solutions. Now, if you read 40A1A, it says disallowance shall be that of 30% of any sum payable on which tax was required to be deducted but not deducted, or having deducted not remitted. The key here is for Karnataka High Court, 30% of any sum payable. Now, emphasizing on the phrase sum payable, Karnataka High Court concludes that this sum payable denotes a monetary outgo. It denotes a expenditure. So, what you can disallow under 40A1A is only a expenditure. Depreciation is not an expenditure. Depreciation is a allowance. Perfect. Okay. How do you handle short deduction cases in your office? There's a 10 lakh professional fee that I had to pay to you, or rather I had to receive from you. You ought to have deducted TDS under 194J 1 lakh rupees, but for some reason you ended up deducting only 50,000 rupees. There's a short deduction. So should the entire 10 lakh be disallowed, or can the entire 10 lakh be allowed in terms of 40A1A? Should 40A1A disallowance be attracted through this transaction or no? That, yeah, 30% of 10 lakh, should there be a disallowance or no? Madam has a midway. Madam says 10 and 0 ke beech mein I have 5 lakh. So to the extent of 5 lakh, at least the expenditure is covered by 50,000 of proper TDS. So 5 lakhs ko chhod do, 5 lakhs ko disallow. Okay, it was a very simplistic example. Okay, but arithmetically we can work this out in any scenario. The courts have seen it, yes or no. Before the courts, it's been a yes scenario or a no scenario. We have a bunch of High Court decisions, starting from Tekriwal, Calcutta High Court. Most of the interesting judgments come from Calcutta, no? At least the favorable ones more come. If you do a statistical analysis, I'm sure you will find before Calcutta Tribunal and High Court, you have more favorable judgments than adverse, specifically on some of the more disputed and controversial matters, no? Be it bogus purchases or penny stock. The first round of favorable judgments always originate from there. Anyways, back to the topic. Now, what Calcutta High Court in Tekriwal case says is, see, What does 40A1A tell you? 40A1A tells you 30% shall be disallowed in the event of non-deduction or non-remittance. Where is the question of short deduction being disallowed under 40A1A? There is some deduction, no. It's not a case of non-deduction, it's not a case of non-remittance. So, hello. But then Kerala High Court is dug up further. PVS Memorial. Read 40A1A properly, sir. It says 30% of sum payable on which tax is deductible in accordance with the provisions of Chapter 17B, and such tax has not been deducted. Such tax is the key over here. Have you deducted the tax actually deductible under 194J? No. Answer is no. So Kerala High Court says no. 40A1A does not postulate a scenario of complete failure to deduct. Even a partial failure to deduct would attract disallowance under 40A1A. Which one should I choose? Whichever is favorable to the SSE. That's in fact the law of precedence. Law of precedence tells me that if I have two contradictory judgments of non-jurisdictional high courts, the one favoring the SSE is what has to be applied. This is interesting. Does disallowance under 40A1A apply in case of failure to deduct tax at source under 194R? 194R, relatively new section, no, TDS provision, introduced 1st of July 2022 onwards. Loosely put, in short words, what does 194R require? 194R requires TDS on any benefit or perquisite that you pay in the course of business. For the sake of our discussion, we'll take a very simplistic example. Manufacturer comes up with a sales target, annual sales target. You achieve this target, I'll give you a Hyundai car, 10 lakh rupees. As a manufacturer, I gave you that car, but I forgot 194R. Now let's say the car costed me 10 lakh rupees. Would I have to suffer a disallowance under 40A1A? I'll repeat the scenario. As a manufacturer, I have given a business benefit, a business perquisite of a four-wheeled vehicle costing 10 lakh rupees for having met some sales target. You are my distributor. I have not done TDS under 194R. Should a 40A1A disallowance be attracted? Yes. Can we build up an argument to say no? We'll try. We'll make an attempt. For 194R, there is no turnover criteria, sir. 10 lakh rupees, more than 20,000. Sorry. Target is fixed, achieved, and car is being delivered to you. Okay. 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 This is conditional, and you met the condition. You've earned the benefit. Okay. We'll go through the provisions and then we'll see and come back and see if we can build on to what you're trying to say. Now, what does 40A1A tell you? 40A1A tells you 30% of sum payable on which tax is deductible but not deducted. The key here is deductible and not deducted. Please catch on to these phrases. Tax is deductible at source, but such tax has not been deducted at source. Why are we discussing? 194R TDS obligation is squarely attracted. No. Should I do 10% on that 10 lakh? Yes or no? The answer is squarely yes. But am I deducting tax over here? 194R, any person responsible for providing any benefit or perquisite shall ensure that tax has been deducted. Is deduction at all possible in this scenario? Engine में रख लेता हूँ, body you keep. Not an option, right? So does TDS provision fail over here? No. TDS provision does not fail over here because this has been forethought, and there is a proviso below 194R which would say, in a case where the benefit of perquisite is in cash or partly in cash and partly in kind, and the cash component is not sufficient to cover the quantum of TDS, the releaser of that benefit or perquisite has to ensure that tax required to be deducted has been paid in respect of the benefit of perquisite. So TDS is well safeguarded over here by virtue of the proviso. But then the proviso does not have a deduction obligation. It has a payment obligation. 40A1A triggers when there is a deduction obligation. Only when tax is deductible and not deducted is where 190 or 40A1A provisions would trigger. In the example that we have discussed, there is a liability to pay, but there is no obligation to deduct. I know it's a aggressive argument, but possible argument. Possible argument. And it has some judicial backing in a slightly different context. Now, there's a Karnataka High Court judgment in the case of Hindustan Lever Limited. It's an old judgment which deals with pre-amended 2011. 2011 assessee in default today covers 3 scenarios: failure to deduct, failure to pay, and failure to remit after having deducted. Now, prior to this judgment, 2011 covered only 2 scenarios: failure to deduct and failure to remit after having deducted. Now, Hindustan Unilever came up with these lucky draw options: scratch and win, lucky draw, wherein you win a gold coin, you win a car, you win a foreign trip, XYZ, which back then required TDS under 194B. The 194B, if you read, has similar proviso as you would see in the case of 194R, where the winnings is in kind, you won't deduct but you will pay. Hindustan Unilever, for some reason, failed to discharge its TDS obligations under 194B. Department initiated 2011 proceeding. Matter went up to High Court. High Court said no chance of 2011. 2011 back then applied only when there is a failure to deduct. Proviso to 194B, where the TDS obligation arose, did not have any requirement to deduct. Therefore, 2011 quashed. Right? Subsequently, 2011 is amended. Now, in the example that we have discussed, 2011 liability will still attract. 40A1A disallowance, in my humble view, should not attract. Right? This is the Hindustan Unilever. So this is how the old 2011 read. It triggered when there was a failure to deduct, or after deducting there was a failure to tax, failure to pay the tax. Right? Remuneration to partners is another item of reporting under clause 21. Clause 21 is a really long clause, no? Probably the longest clause that we have in 3CD. Now, with regards to remuneration, 40B gives us a bunch of conditions and a restriction. Right? The conditions given to us is: when is remuneration to partners allowable as deduction? For remuneration to be allowable as deduction, condition number 1, it should be authorized in the deed. The authorization has to be prospective. 3, remuneration has to be paid to a working partner. Remuneration paid to a non-working partner, no deduction. And then there is a cap given to us. There is a restriction given to us. What is the restriction? 90% of first 6 lakhs of book profit or 3 lakh, whichever is higher, and 60% of balance book profit. The book profit is the key here. Book profit is the key here. What is book profit? Book profit is the income under the head PGBP after taking into account all allowances and disallowances, barring remuneration to partners. Other than this item of allowance or disallowance, do all your computation. The number that you derive, the number that you get is your book profit. We have a series of questions pertaining to, connected to book profit. Should interest from fixed deposit be included for computing book profit? How would it make a difference? Interest, whether taxed under PGBP or IFOS, will suffer the same 30% flat rate. No. Does it make a difference? Yes. It will not make a difference from the point of tax computation on the interest per se, but then if interest you're offering it to tax under PGBP, then your book profit is going to be higher. If your book profit is going to be higher, the remuneration allowable to partners is going to be higher. So back to the question. Is interest PGBP or IFOS? That was a case which came up before Gujarat High Court in JJ Industries. The JJ Industries was into cotton ginning works, which is a seasonal business, right? Now there, during off-season when they had surplus funds, the partnership firm invested the surplus funds into fixed deposits, earned interest, and that interest it sought to offer it to tax under PGBP. Department assessing officer said, no, it is not PGBP. I will push it down to IFOS, reduce your book profit, reduce the remuneration allowable to partners, and accordingly raise demand. Matter went up to Gujarat High Court, and Gujarat High Court concluded, no. What you have to look at is, what is the source of this FD? Source of this FD is surplus temporary business funds, right? And therefore, this surplus temporary business funds has to be, interest out of such surplus temporary business funds has to be taxed on the head, PGBP, and not IFOS. Now, what is the best way of drafting a remuneration clause? Most efficient way of drafting a remuneration clause? Beginning of the year, I executed a deed 50,000 per month. End of the year, I realized, hey, 70 dalna tha re. I put 70, but end of the year, I realized it is excessive. I'm getting deduction for only 40, and now I have ended up with a negative P&L. I have problems with my banker now. What is the most efficient way of balancing this? As per Act, that 40B limit of 60%, 90%, pull that formula and put it in the deed. So for a very long period of time, department always contested that this is not allowable. I'll disallow it. Reason, the deed fails to quantify how much is the actual remuneration payable to the partners. Matter traveled up to courts in a series of judgment, including Karnataka High Court, but then before Karnataka High Court, we had this landmark in Anil Hardware Stores, Himachal Pradesh High Court, wherein court said, no, look at the provisions of 40B. What is the requirement under 40B? Requirement under 40B is, it has to be authorized and not quantified. As long as the deed is providing you for an authorization and formula for arriving at that authorization, it's a valid clause, and depreciation has to be allowed, cannot be disallowed. But then if your deed has vague clauses, which we see a lot of times from in the LLP agreements, which lawyers, non-accounting, non-tax professionals drafted, it will be very vaguely worded to say remuneration as may be decided by the partners from time to time. No, sorry, that's not allowable. There has to be a express authorization, if not a quantification, some mechanism of arriving at the amount of remuneration payable to partners. Can salary paid to partners be disallowed under 48(2)A on the grounds of it being excessive? Great City Manufacturing Company, Allahabad High Court. In this case, assessing officer noted that the partner is paid a salary of 36 lakhs, which is within 40B limits. It's not breaching the 40B limit. But then he saw the next highest paid employee of the firm is manager being paid 4 lakh. He said, this is excessive. This is unreasonable. I will disallow it under 48(2)A, payment to relatives. High Court said nothing doing. When the law has expressly provided for a limit under 40B(5), 48(2)A would not have any application in this scenario. Again, specific provision would override general provision. Can a firm be compelled to charge interest and remuneration where it is provided for in the partnership deed? Dinesh India. Now, this was a partnership firm which was enjoying 10A benefit. Now, because it was enjoying 10A benefit, it did not pay any interest, it did not pay any remuneration to partners. Makes sense, no? Retain the profit here, anyways, whole of it is exempt. If I pay interest and salary, my exemption reduces, but that interest and salary would get taxed in the hands of the partners. So, why at all pay interest and salary? No interest and salary was paid. But then, unfortunately, the partnership deed was a standard partnership deed which had an interest clause and which had a remuneration clause. Assessing officer reworked the profits of the firm to say, no, deed provides for interest at so and so rate, deed provides for remuneration. I will reduce your profit, I will reduce the exemption, I will tax this interest and remuneration in the hands of the partners. Court said nothing doing. You cannot override the commercial wisdom of the partners. If the partners, despite the deed authorizing, have decided not to pay any interest or salary to themselves, it cannot be forced upon them. It cannot be forced upon them. Now, while we may not encounter 10A kind of cases now, this can be put to use in cases where there is a debit capital balance. We occasionally encounter such scenarios wherein partnership deed provides for interest payout on all capital balances, including debit balances. But when there is a debit balance of the partner, no interest is actually provisioned in the books. No interest is actually provisioned in the books, and assessing officer seeks to recompute. Hey, deed ಹೇಳ್ತಲ್ಲ on the debit balance also there has to be an interest. I will compute interest on the debit balance and add it as income of the partnership firm. Not possible, because the courts have said you have to leave it to the commercial wisdom and agreement understanding between the partners. You cannot enforce the partnership deed on them and mandate them to compute interest and salary as per the deed requirements. Sir, you will say 45 lakhs is what you have received, but in terms of 28 clause 7, if I'm not wrong, you will take a deduction of 5 lakhs and say 40 is taxable. I'm not sure how it would get reported in the ITR, but at least that's how your computation would work. But that portion of interest and salary for which firm has not got a allowance will not be taxed in the hands of the partner is very clearly there, 28.5 if I'm not wrong. I'll skip this for want of time. We look at prior period items, clause 27. Now, what is prior period item? What is my cutoff time? 4:45. I have another 1 hour to go. Or rather, you have another 1 hour to bear me. Okay. Prior period item, if you go by ASY definition, prior period expenditure is that material expenditure which has arisen in the current year on account of error or omission in the preceding year. One classic example I'll give you. FY 22-23, I was doing a tax audit. In the course of my tax audit, I came across a GST computation error. So any error. There was some supply which should have been taxed at 18%, but for some reason taxed at 12%, or any other computational error. I pointed out to my SSC. GST is out of your income tax audit scope. No, ಬಂದಾಗ ನೋಡೋಣ. Leave it. ಆ ಬಂದಾಗ ನೋಡೋದು ಹೇಳಿದ್ದು ಬಂದ್ಬಿಡ್ತು 24-25 Now I have a order from the GST authorities raising a certain demand for FY 22-23, which I am debiting it to my books for 24-25. Now, technically, in accounting terms, this expenditure of 22-23, which I debit to my P&L of 24-25, is prior period expenditure. It is a liability arising in the current year on account of an error or omission in the preceding years. Thankfully, we have a Gujarat High Court judgment in the case of Saurashtra Cement, a landmark judgment repeatedly cited across all cases involving prior period items, wherein Gujarat High Court said, no, even if the expenditure pertains to a prior year, if the expenditure is crystallized in the current year, it is not a prior period expenditure. When did you receive your GST order? If you received a GST order in 24-25, it's an expenditure of 24-25, it is not a prior period expenditure, no disturbance. Mumbai Tribunal has taken this a step forward in the case of Tata Communications. To say if the invoice is received in the current year, then the liability crystallizes in the current year. To give you an example, let's say I took some service or I bought some goods in the month of January 2024. But the invoice for that was raised in September 2024. I accounted it in 24-25. In accounting terms, is this not a prior period item? I ought to have created, the vendor did not give me an invoice, agreed, but then I ought to have created a provision in my financials for 23-24. I failed to do it. And I received the invoice in 24-25. I debited my P&L for 24-25. It is a clear-cut case of prior period expenditure. But then Mumbai Tribunal comes to your rescue to say, no. If the invoice is raised on you in the current year, the liability is crystallized in the current year, and the liability is crystallized in the current year, it cannot be treated as an item of prior period expenditure. Right? These case laws have to be used in defense and not in tax planning. Sir, when the cases are in our favor, we don't question the logic. All the questioning comes only when you want to go against it. When the wind is flowing in your favorable direction, you sail along with the wind. No, all the fighting happens only when you have to go in the opposite direction. Which is why I said use it in defense and not as liberal tax planning or structuring tool. ठीक है. don't be lenient on your assessee, but be a little, sometimes chhod do. Mazegaon doc is interesting, Bombay High Court. In this case, there was prior period income and there was prior period expense. Department said expense ko bhul jao, income ko tax karo. Court again was a little liberal and lenient to say, okay, net it off, and the net impact is what you will offer it to tax. So then it's not an error or omission of the previous year. So the year in which you've got the demand, that year's, even in accounting terms, I don't think that would be called a prior period item, sir. Prior period item is only where there is an error or omission in the preceding year. Now you are aware of it, you have taken a professional judgment to say, I will not provide for it because this is probably in the nature of contingent liability, or you have provisioned for it on the basis of certain estimate. Let's say you provision 1 lakh and your actual liability turns up to be 3 lakh. Doesn't mean that it was an error. It's just that an estimate is not equal to the actuals. So that shouldn't be a trouble. When you say filed it, you're referring to a sale invoice? Okay. Okay. So you have a twofold problem. Number one, in the year in which you have offered income to tax, you did not have TDS. You missed out on that. Number two, in the year in which TDS is appearing, your sales is lower than the net credit in Form 26As. I'll give you two solutions for your two problems. Problem number one, the TDS which has come in the subsequent year has to be claimed only in year 1, not in year 2. And the way to do it is you'll have to file something called Form 71. Recently, about 2 years back is when we had this amendment. You'll have to file a Form 71 within 2 years from the end of the financial year in which the TDS credit is appearing on the Form 26As. You have a 2-year window. Right? Claim it, go to the assessing officer, he'll do nothing. They don't know how to process it. We filed tons of Form 71, they're lying as it is. The functionality in their ITBA portal is not yet enabled. They don't know how to handle it, basically. 1. 2. In year 2, my 26As turnover is 100, my actual turnover is only 90. Now if I report 90, then I'm in trouble, no? But in my TDS schedule also I would have reported only 90, no? 26As you have 100, out of which 10 pertains to the previous year. And that 10 I will claim it under Form 71, not in this year. Right here. So I think I should be good. Problem, I'll tell you where it arises. Problem arises more where there are some sales returns. This year's turnover is 100. 100 is what is appearing in 26 years. But then I have a credit note out of previous year's sale. There, how do you handle it in ITR? Because I want to claim the entire 100 ka TDS. Now, the way we normally do it in our office is report 110 as sale in the tax PNL, in the ITR PNL, and 10 rupees you report it in other expenses as reversal of last year's sale. So, see, computer is happy, CPC is happy. Sir, in taxation, in practice, mess with anybody, never with CPC. Keep CPC happy. But legally that would be incorrect. In the example that I gave you, 110 and 10 claimed as other expenses, I'm confident that even in an assessment, I should be able to claim the entire 100 ka TDS. But in your case, TDS that you're claiming, for that corresponding income is not offered to tax this year. The income pertains to the previous year. Offered to tax, claim the TDS also in that year is what law says, sir. If you read 199, read with Rule 31 AC or AB something, there it's very categorical to say the income and TDS have to go hand in hand in the same year. So if TDS has come in subsequent year and income is offered in preceding year, Form 71 is your solution. If TDS has come in current year and income is offered to tax in the subsequent year, you'll have to carry forward that TDS in the ITR and claim it over there. So there is a carry forward in the ITR and there is a carry back by way of Form 71. So you've written off some inventory, you will have to claim it in this year and the year in which you have written it off. I don't see a trouble there. So where does he want to? It is not an expenditure. There's no debit to the P&L. No, it is just that you've reworked your closing stock to appropriate number. Where is the question of disallowance? He wants to rework your opening stock. Okay, so basically he wants to accept your closing stock, but he wants to tamper your opening stock. Correct? So please read out to him ICDS 2. If I'm not wrong, it is para 8, where it very categorically tells you opening stock has to be the closing stock of previous year. Nobody can touch it. Neither you, neither SSC, nor the assessing officer. Unless and until last year's closing stock is disturbed, he cannot disturb current year's opening stock. That's very clear in ICDS 2. I'm not reducing opening stock, I'm reducing closing stock. And that reduction is valid because that stock does not exist. Officer will say 10 things, madam. We'll do what we want. So I think in the appeal, your line of argument should run along with ICDS 2. There you have good backing. Form 71, sir. Form 71. You have 2 years from the end of 24-25. So before 31st March 2027, you have to make your claim by filing Form 27, Form 71.
GST turnover appearing in 26 years. There is a mismatch from books of account.
Yeah.
How we have to adjust that?
I don't think we should be too troubled by the turnover reported in GSTR 3B. GSTR 3B turnover and your P&L turnover will not reconcile in most of the cases for tons of reasons. Tons of reasons. GSTR 3B probably has some reporting of preceding year. GSTR 3B you probably omitted to report something. I don't see that as a trouble. You should possibly, for the purpose of your audit documentation, you should have a reconciliation statement working in place. But I don't see any trouble over there. Possible. Let them issue. We'll give a reconciliation statement. Can bonus shares be taxed? I skipped clause 26. A very dangerous judgment, but a favorable judgment. You want to use it, but at your risk. Now, 43B, in the long list of expenses which it says shall be allowable on cash system, also includes bonus to employees, right? Now, Chandigarh and Mumbai Tribunal in these cases have held that 43B disallowance with regards to bonus would be applicable only to statutory bonus. The bonus that is payable under the Bonus Act is only what is covered under 43B. The bonus which is beyond the Bonus Act, that is voluntary bonus, is not to be disallowed under 43B. Proceed with caution. I would disagree with it. It makes references to a lot of provisions, lot of prior judgments, which post those judgments have undergone some amendments. So, at your risk. $194R applicable? Definitely no, sir, because it has to be in the course of business, no. 194R is business perquisites, business benefits. This is not, share issue is not a business perquisite. But can bonus shares be taxed under 56(2)(10)? Receipt of shares without any consideration. When I receive bonus shares, let's say I'm holding 100 shares of Infosys. Infosys comes up with a bonus issue 1:1. I now hold 200 shares of Infosys. For the additional 100 shares that I've received from Infosys, have I paid any consideration? can it be taxed under 56(2)(10)? Why? Precisely what Karnataka High Court said in the case of Dr. Ranjan Pai. What Karnataka High Court said is, see, look at the bonus setup. Pre-bonus, post-bonus, there is no increase in the net wealth of the SSC. The market value as well as the intrinsic value of the shares of the SSC remains more or less the same. There could be some variation, market fluctuation, but then largely it remains the same. So when I was holding 100 shares of Infosys, let's say the value of each share was 1,000. Immediately after bonus, the value will come down to 500. So the 100 shares that I have received, the consideration for that I pay is diminution in the value of my existing shares. So it is not a case of 56(2)(10) income. This is nice. Is gift received by a member of HUF from the HUF taxable under 56(2)(10)? No? Sure. Very clear. Sir, if you look at the list of relatives, a member of the HUF is a relative. HUF is not a relative. Member of the HUF making gift to the HUF, under the law, no 56(2)(10). Clubbing provisions might apply, that's a different story. But then HUF giving gift to the member is not expressly covered under the list of relatives. It is implied, sir says it is implied, precisely what Rajkot Tribunal said. See, look at the list of relatives. Brother, sister, spouse, ancestor, lineal, descendant, ascendant, everybody is covered, right? When I can individually receive gift from each of those, why cannot I receive a gift from them as a collective family? HUF is nothing but a collection of those individuals, no? So when I can individually take gift from them and not suffer tax under 56(2)(10), why should I suffer tax when I am getting it from them collectively as a family? May not be sound logic, but a favorable judgment, which got rectified, course corrected by Ahmedabad Tribunal. There is nothing doing. Idella logic work agala. Look at the list of relatives. Do you have HUF as a list of? As I said, member of HUF is a relative, but HUF is it a relative? No, pay tax. Kalas. But the law beautifully evolved before Chandigarh Tribunal. Pankil Garg. Beautiful analysis. Chandigarh ITAT equates HUF with a partnership firm. Like in a partnership setup where a partner gets share in profit and has a right in the assets of the partnership firm, a member of a HUF is entitled to share in income of the HUF and share in assets of the HUF. The only difference being, in a partnership firm, the share of partner is determinate, it is pre-decided. In a HUF, it is to the discretion of the Karta. Karta decides who gets how much, right? So when a partner draws money from the partnership firm, it is either his share of profit, which is exempt under 10(2)(a), or it is his share of capital which he is withdrawing. It is capital receipt. Right? Likewise, when when a member draws money from HUF, he is either getting share of his income in the HUF, which is specifically exempt under 10(2), or he is withdrawing his existing share in the assets of the HUF, which is a capital receipt. In both scenarios, not taxable. Better and more sound logic than what we had from Rajkot Tribunal.
About double taxation. HUF also pays tax and give a gift to a member, and he also has to pay the tax.
But those are two separate SSCs. No? Then this logic would also apply to companies where company pays tax and shareholders pays tax as by way of dividend. That logic would be hard to argue. This I think works fair. 10(2), 10(2)(a) analogy is a sound argument. Payments made through checks. I'll cut short in the interest of time. I'll straight away come to the issue. I was required to pay a micro vendor before 31st of March. I did not pay him, but I issued him a check. How I issued him, I don't know. I issued him a check dated 31st of March, which got cleared, debited my bank account on 15th of June. Would 43BH disallowance attract or no? The due date to make payment to that vendor was 31st of March. That 15-day, 45-day time limit expired on 31st of March. What is the date of my payment here? The day on which I hand over the check and make an entry in my books of accounts, or the day on which it actually debits my bank account. Money actually flows out from my account and gets deposited into the vendor's account. Check date. Check date. Check is a negotiable instrument. If you read section 6 of the Negotiable Instrument Act, the Negotiable Instrument Act would tell you, would define check as a bill of exchange drawn on a bank payable on demand. Right? So it's a negotiable instrument which gets negotiated by way of delivery. That is simple delivery in case of open check, or endorsement and delivery where there is a crossing made. Right? So as when it is negotiated, when it is delivered is when the date of payment is actually to be recognized. And this is told to us by, there are numerous case laws on this in different contexts, but then it can equally be applied here. Check is considered to be a form of payment when it is delivered. This is what Supreme Court tells us. Regardless of when it is actually presented for payment, the actual date of payment for a check is the date on which the check is handed over. Right? So date of the check is also not what matters. Actually, the date on which you hand it over is the date of payment. So on that date, you should also collect a receipt from your vendor to say that yes, on so and so date, I have received the check of so and so value, so and so check number. The date on which check is encashed is simply the date on which funds are transferred from the payer's account to the payer's account. If a check is post-dated, the date of payment will be the date of the check, even if it is delivered before that date. So in case of a pre-dated check, the date of payment is the date of delivery. But in case of a post-dated check dated 15th April, I hand it over on 31st of March. The date of payment is not 31st of March, it is 15th April. There is one more in the context of 43B. It again supports our conclusion, but on a different reasoning. Now in the case of this Hindustan Wire product, a certain payment was made on 15th of April to LIC, right? Rather on 31st of March. 31st of March is when a check was handed over to LIC towards some gratuity obligation. And the law that prevailed then required the gratuity to be paid before 15th of April, failing which there was some disallowance under 43B. The check for some reason cleared on, I think, 24th of April. Yeah, 24th of April. Assessing officer said, see, in your bank account, it is getting debited on 24th of April. 24th of April is the date of payment, which is beyond the statutory limit of 15th April. I will make a disallowance under 43B. Court came to the rescue to say, hey, see, LIC has given you a receipt dated 31st of March. Now, why it got cleared on 24th of April, for what reason, delay on the part of the LIC or the bankers, is something which is beyond the control of the SSC. For a default of a third party, over which the SSC has no control, you cannot penalize the SSC, you cannot make a disallowance in the hands of the SSC. Dangerous. Clause 32 requires us to report on brought forward losses, right? Brought forward and carry forward losses. Can brought forward depreciation loss be set off against current year IFOS? IFOS is income from other sources. I have interest income of 10 lakhs in the current year, which I am offering it to tax under income from other sources. I have brought forward depreciation loss of 10 lakhs. Can I set it off? Yes. Yes. That's been our childhood understanding of brought forward, carry forward provisions, right? Kerala High Court says no. Kerala High Court says no. Section 71 deals with current year set off. Current year business loss can be set off against any head of income other than salaries. Correct? 72 deals with brought forward business loss. It says brought forward business loss shall be set off against only current year business income. Right? Then there is 32 which deals with depreciation. More importantly, 32 subsection 2 which tells you that portion of depreciation which could not be absorbed in the current year shall be carried forward, and in the subsequent year it will become current year depreciation. In simple words, brought forward depreciation is as good as current year depreciation. But 32.2 explicitly says that it is going to be subject to 72 subsection 2. Now what does 72 subsection 2 tell you? 72 subsection 2 only simply gives you order of set off. It says when you have business loss and depreciation loss brought forward, you will first set off business loss and then depreciation loss. Now, citing this referral of 32.2 to 72.2, Kerala High Court says provisions of 32.2 is subject to Section 72. And because Section 72 permits you to set off current year losses only against current year business income, you cannot set it off against current year other sources income. No, this decision is how it is. But then, hard to digest, no? Should we follow it? Alapat Jewelers, a recent one, 2024 judgment. Hard to digest. It is in direct contradiction with our childhood understanding of set of provisions. Since the day we've been reading and understanding set of carry forward provisions since our intermediate IPCC days, we are told that depreciation loss is like, it is like Superman. It lives forever and fights with all. Right? And it is also in direct contradiction with a host of Supreme Court judgments, not just High Court. There are Supreme Court judgments on this specific matter which says no, brought forward depreciation loss can be set off against any income other than salary income. What do we do? Supreme Court is supreme. That's something we will not follow. Now, why I brought this slide up is to make us understand that conclusion of a judgment is not necessarily final. Or rather, when we read a judgment, we should not restrict our read only to the conclusion of judgment and simply apply it. Now, here you all disagreed with it because it was something very clear and very hard to digest, and it was going against you. We've seen more judgments in the past, sir, where hard to judge, but because it was in our favor, we said, okay. Correct? Now, the point that we have to understand is, number one, don't just restrict your read to a conclusion, get into a reading of the logic and the ratio behind it, test it to your set of facts, and then take a call, then take a decision. One. Two, there may be a lot of favorable judgments out there, but then we know courts, sometimes travel on novel paths and they get course corrected. This will undergo a correction, certainly, right? But then we should not get carried away by a favorable or unfavorable conclusion of any particular judgment. It has to be tested and accordingly applied. Brought forward losses, again, continuation. Can brought forward business loss be set off against capital gains arising from sale of business asset? Brought forward business loss 72, we just read, no, can be set off only against business income. Correct? I'll give you an example, illustration to make this more clear. I am a manufacturing entity into constant losses. I have 10 crores of brought forward business loss. I have shut shop. I have decided to sell my land, building, plant, machinery, everything. I have sold all of it and I have earned a capital gain of 10 crores this year from sale of my business assets. Now this 10 crore capital gain, can I set off against 10 crore brought forward business loss? No? Karnataka High Court says yes. Yes, with a very strong logic. If you read 72(1), brought forward business loss, it shall be set off against profits and gains, if any, of any business or profession carried on by him and assessable for that assessment year. It says brought forward business loss can be set off against profits and gains from business or profession. It does not say profits and gains chargeable to tax under the head business or profession. Now this factory land, factory machinery, factory building which I am selling and earning income, is it not business asset? The profit that I earn out of it, is it not business income? It is chargeable to tax under that capital gain, I agree. But is it not business income? In its core nature, is it not income from business? The set off is permissible, because what is permissible is set off against business profits and not set off against profits chargeable to tax under the head PGBP. That's not the restriction given to you here. ITR will not allow you this. You will have to do a lot of jugaad to be able to get to this. So you'll have to do some other deductions wala claim to get to this result. Nandi Steels, Karnataka High Court. No, if your jugaad goes under CPC's radar, possibly you will not get a notice also. When the judgment is sound and it is convincing to me, I would do it for smaller amounts as well. Sir, ಮುಚ್ಕೊಂಡು ಹೋಗ್ತಾ ಇದ್ದಾನೆ ಕಂಪನಿನ ಪಾಪ ಅಸೆಟ್ ಎಲ್ಲ ಮಾರ್ಕೊಂಡು ಹೋಗ್ತಾ ಇದ್ದಾನೆ. Now if you have to ask him to pay taxes also, when you say he has got brought forward loss of 10 crore, he'll have 10 crore of liability also for sure. Out of that 10 crore, if you ask him to pay 12.5% or 30% because it's a depreciable asset, 3 crores you have to pay. So 3 crores to be paid to department vis-a-vis 3 crores to be paid to lenders. You will obviously come forward to try and help him out. This is interesting and something that we have to be very cautious about. A common advice that normally goes wrong. Closing Private Limited gives the following data. Brought forward business loss 5 crores. Loan payable to director waived and credited to P&L 5 crores. Query. Can the current year income be set off against brought forward business loss? This is the normal advice we give to most startups. No, startups who want to shut down have two routes available to them. Either go through the NCLT route, voluntary liquidation, or go through strike-off mode. But for strike-off, the assets and liabilities have to be zero. Most startups are left with only what at the end of their closure of business operations? You will have losses, you will have share capital, and you will have one director's loan sitting in the balance sheet. The normal advice given to the startups is write back that loan credited to P&L. You will have sufficient brought forward business loss, set it off, file a return, close. Is that a correct advice? Now, we all know for sure one thing, that the brought forward business loss can be set off only against business income. Correct? Now, the test to be applied is this 5 crore loan payable to director, which I am crediting it to my P&L account, will it end up being taxed under PGBP? Yes, which section, sir? 41(1), remission of liabilities, remission and cessation of liabilities. If you read 41(1) carefully, it talks of remission and cessation of only trading liabilities. It talks of only remission and cessation of trading liability. That liability which in the past has given you some allowance or expenditure and now you're getting any benefit or remission or cessation out of it is what gets taxed under 41(1). Loan from directors is not a trading liability. Mahindra & Mahindra, Supreme Court. So, sir 28 में tax कर देते हैं ना. Benefit of perquisite post 2024 we have the scope of 28.4 being expanded to include even monetary perquisite. Prior to 2024, what could be taxed under 28.4 by way of perquisite and benefit was only non-monetary. Now even monetary perquisites are taxable under 28.4. So let's tax it over there. No, that will also not help you, because under 28.4 only those benefits and perquisites which arise in the course of business are taxable under 28.4. Meaning it should be a business receipt in the course of business. It has to be a revenue receipt. So all these judgments which were in our favor could now turn up against us in this context. So 28 illa, 41 illa, not at all PGBP income. So not at all income, even better, no. Will it attract 56-10 is a question that we have to ask ourselves, sir. Very dicey, very litigative. One way of arguing it is 56-10 applies only when there is a receipt of money without consideration. Is the loan written off receipt? Am I receiving money? Of course I have received money. But years back, That receipt was years back in the year in which I borrowed, and that was not without consideration then. Now, this year, can you say it is receipt of sum of money without consideration? Now, in this Mahindra and Mahindra case, when the Supreme Court was dealing with 28.4 and 41.1, it's made a very powerful statement there. There, Supreme Court says when the creditor waives off a liability, it results in surplus cash in the hands of the debtor. It's a receipt of money in the hands of the debtor. A very strong line which goes against this. And because it's coming from the Supreme Court, it's the law of the land, and department is going to cling to it and tax this charge of or write back of loan under 56(2)(10). And if that happens, your brought forward business laws may not come to your rescue. So the safe route out is, the safe option out is, don't charge off that loan to the P&L, capitalize it by issuing shares against it, and then shut the company. पैसे का ना जाना भी आना है, हाँ, so you are siding with the department, sir. So the safer route in this startup shutdown scenarios is capitalize the loan and don't write back the loan. There's a risk. There's a big risk. Original return filed under 139(1), reporting profits. Revised return filed after due date, reported losses. Can the loss be carried forward? Yes. Original return, I filed on 16 September, that was my due date. 16 September 2025. And then I realized there was a capital loss which I forgot to claim. I revise it now. Can that loss be carried forward? Childhood understanding of revised return. Dhampur Sugar Mills revised return substitutes the original return. It goes and sits in the shoes of the original return. Unfortunately, be very careful. The answer is no. Wipro Limited, Supreme Court of India. The statement made there is, this is verbatim. Revised return filed by SSC under section 139(5) can only substitute its original return filed under 139(1) and cannot transform it into a return under 139(3) in order to avail benefit of carry forward or set off of any loss under 80. Unfortunate judgment. But it is coming from the highest authority. Against this judgment, Wipro filed a review petition, dismissed. So it has become even stronger now. Stamp duty, authorized capital, issued at a premium, no? Now 56(2)(7)(b) is also not there. Do a right issue, valuation report not required. There's a solution for every problem, sir. This I'll skip in the interest of time. The idea was to have a 15 minutes of open house wherein we can raise any issue and together try to break our heads and see if we can have a solution. Issues which are live in our offices. Do we get to that or do I continue with this? Continue? Sure. Then let me look at what is more. 36(1)(5)(a). PF ESI due date in case of holiday. My PF due date for the month of July is 15th August, Independence Day. I made the payment on 16th August. Disallowance attracted, not attracted? Attracted? There's a bunch of Delhi High Court and Delhi Tribunal judgments starting with PepsiCo India, which is not attracted. Why? Section 10 of General Clauses Act. If the due date falls on a holiday, compliance on the immediate subsequent day is sufficient compliance. Dangerous judgment, sir. If you read section 10 of General Clauses Act, it will tell you if the due date happens to be on a holiday, it is preventing you from complying on that due date for reasons beyond your control. You cannot be penalized. That's the logic, and that's not the exact wordings over there, but then it's on similar lines over there. Today, PF, ESI, TDS, everything is paid online, which is available 24/7. So in my humble view, it's a dangerous argument to make, and again, course correction will happen at some point of time. But if you want to save your SSC and at the same time save yourself also, in your 3CD you may probably not report the disallowance and make a observation in your 3CD to say disallowance is not warranted. Okay, that's one. I'll give you a more difficult scenario. I had an employee, I deducted his PF. I've hired him in the month of October, I've deducted his PF. I am required to remit it before 15th of November. On PF account, I create agila. Some Aadhaar mismatch, some problem, some technical stuff is happening over there. I remit it, let's say 15th of December. Disallowance attracted? Court say no. Court say no. FIL India Business and Research. It's on a slightly different fact pattern, but then the moral over there is to say for reasons beyond the SSC's control, if there is a delay, if there is a technical issue, either with the portal or instances like these, then there cannot be a disallowance. You cannot penalize him for what he is not responsible for. Yeah. So you'll have to fight it out here. But the moment you report it in your 3CD, CPC to disallow karega hi. You'll have to carry it in appeal. NPS is in fashion now, no? Every employer wants an NPS component in his pay pack. Every employee wants an NPS component in the pay pack, and every employer is now compelled to follow the employee's demand. So for the month of April, I collected NPS contribution from the employee, let's say 50,000. I remitted it on 15th December 2024. 36,158 disallowance attracted, not attracted. There is a delay in NPS contribution. I collected in the month of April, I remitted in the month of December. Interestingly, the PFRDA Act does not prescribe a due date for NPS contribution. So there is no disallowance. Adani Baba ki jai. We have two Adani cases on this to say disallowance is not attracted. But then there is one more Chandigarh tribunal case which says, in this case, the contribution was never made at all. It's not a case of delayed contribution, it was a case of no contribution. Therefore, there they said, no, nothing doing, you will have to disallow it. Expenses incurred for raising funds. I think we have another 5 minutes to go. 43 disallowance. More than 10,000 in cash, 100% disallowance. My SSC did not pay my vendor in cash, but deposited the consideration into the vendor's bank account. I was supposed to pay my vendor 1 lakh rupees. I didn't make an account pay check, but 1 lakh rupees I went and deposited it into his bank account. Disallowance attracted, not attracted? Attracted? Sir is very strict. We have a favorable judgment of Bangalore Tribunal, Renukeshwara Rice Mills. See, look at the vendor's books. Did he receive cash in hand? It has come to him in his bank account. So, no disallowance. Very lenient and liberal approach. But then Allahabad High Court says nothing doing. Read the law. What does it require? Account pay check or electronic modes. This is not passing through any electronic clearance services. It is not leaving any audit trail. Disallow. So you have both ways. Use it with caution and use it only in defense and not in planning. Quantum of disallowance. I made 12,000 payment in cash to an employee. His salary I paid him in cash. Poor fellow did not have a bank account. I paid him in cash. Quantum of disallowance? 100%. So entire 12,000 has to be disallowed. There is one Dharwad bench judgment of Karnataka High Court in Shankar S. Kolinad, where High Court says 2,000. Up to 10,000 there is no disallowance. Up to 10,000 there is no default. The default starts only beyond 10,000. So only disallow the default part. There is an item of disallowance the item of expenditure which is fitting into two disallowance provisions. Can I disallow it under both the provisions? No, there cannot be a double disallowance. Again, the golden rule, the disallowance cannot exceed the claim for allowance. Sir is here. It's an indicator that I have to wind up. Probably 2 more slides. Personal expenses. We are required to report personal expenses on clause 21. Whichever is higher. Now, to understand personal expenses, we should all read this judgment of Supreme Court, State of Madras versus G.J. Coelho. I don't know how do you pronounce it. Earlier judgments used to be very nice, no? 1.5, 2 pages, crisp to the point, and really, although short but detailed. Right? It's a matter involving agricultural income tax, but then it exhaustively tells you what the personal expenditure is. The crux of it that comes out of this judgment is personal expenditure are those expenses which are incurred to meet the personal needs of the assessee, personal needs of the person like food, clothing, etc. By virtue of this reasoning, courts have concluded that a company cannot have personal expenses. A company cannot have personal expenses. Now, there's a company which purchased a luxury sports car, which is used by the director. The depreciation on other expenses incurred on the car were disallowed by the AO. Now, extending the logic of Supreme Court, Mumbai Tribunal in this case concluded that no. It's a company. Company can never have a personal expenditure. It is something which cannot be disallowed under 37(1). Again, a dangerous judgment. It is not a personal expenditure, okay. But is it a business expenditure or something which was not questioned and tested over there? Has it got any nexus? Is it incurred wholly and exclusively for the purpose of business? Is something which was not tested over there. One last slide, sir, before I wind up. In continuation of this personal expenditure issue, it is today a fashion, no, to go abroad for higher studies, UK, Australia, USA. And it's a tax trend to fund that higher study expenditure of the director's son or daughter out of the company books. Can claim an expenditure. How far is it safe? How far is it allowable? Director's son wants to study in Australia, 10 lakh rupees admission fee, company pays for it, claims it as an expenditure in the books. Allowable? Other employees, no, director's son, how can you be so partial on them, sir? How can you be so? No, there are judgments both ways, sir. There are judgments which are for, there are judgments which are against also. Very factual based. At end of it, if you go through all these judgments, you will realize that it all boils down to the documentation that you have maintained. If there is an employment agreement, if there's a binding employment agreement which mandates that employee or that individual who's going outside India for foreign study, if you're binding him to work for the company for the next 3 or 5 years, once he is back and apply his knowledge for the growth and welfare of the company, then you have a good case. If he is a pre-existing employee, your case is even better. But then if you miss out on the documentation, like how Mustang Moldings did in the case of Mumbai Tribunal observed that yes, there is an employment agreement, but then the admission process had started much before the employment agreement. Such an afterthought, court said, and rejected it all. So, as I said, it all boils down to how good your documentation and explanation to justify that expenditure is. Right? I think for shortage of time, I'll have to stop with my slides, but if there are a few queries, we'll quickly take them up in next 1 or 2 minutes. Should be still allowable, sir. As I said, it all boils down to the explanation that you give. But then wouldn't it get tax in the hands of the employee as perquisite? Academic allowance are exempt. Academic allowance is there, no? Exempt. Right, so I think with this, I'll stop unless if there is more queries or something more to add and contribute. From my end, I take this session as concluded. Thank you all for a very patient and interactive hearing. Thank you.
ತುಂಬ ಒತ್ತು Please. Yeah, members, just it is customary to give the vote of thanks. I thank the speaker for the day, and I request the chairman to please hand over the memento to the speaker. Members, let's have a round of applause. Yeah, members, there is a high tea arranged. Please do have it. Thank you, and have a great evening. Thank you.